Thank you everyone for joining us. This is the second in our five-part series about fund management. This one being what to consider when starting a fund. This one a specific case study with our guest Todd Owens. So Matt, take it away.
Thank you, Kylie. Thanks everybody for joining us. Todd, welcome to the program. How you doing?
Very well, thank you. Happy to be here.
Yeah, good. Well, happy to have you. Todd and I got to know each other a while back. He was introduced to me through a mutual acquaintance, and talked a lot about different things over time, including the GP stakes that he's involved in, which is kind of fascinating, and we'll get into that a little bit today. But I thought that this would be a good case study for folks on the call to kind of hear from someone who's been doing it for a long time and some of the things that they learned in setting up a fund, trials and tribulations, what worked, what didn't, investor base, etc., as well as kind of the investment strategy and the differentiation of an investment strategy and so forth. So we might start anywhere and go everywhere here a little bit today, but start off maybe, and Todd, give us a little bit about your background, kind of give folks some familiarity with kind of where you came from, and then we'll kind of dive into the fund creation and investor capital journey.
Okay, happy to do it. And my background really is on the advisory side, not on the investing side, which created challenges as we were building out our business, but we'll get to that in a second, I suspect. I grew up on the West Coast, went east for college, fell in with the wrong crowd, and started my career at Goldman Sachs. I was there for 25 years, mostly based on the West Coast, and was in the financial institutions group of Goldman, advising financial services companies, which include asset management, alternative asset management, and so forth, as well as I ran Goldman's coverage of the specialty finance space, which increasingly is shifting toward a more asset management type model. I left Goldman after 25 years and went to work for a client, which was a private credit firm called Fifth Street. That firm was the external manager of two publicly traded business development companies, 40 Act vehicles. I was the CEO of one of those and the president of another. That business was sold to Oaktree, and I came back into advisory work at Broadhaven, and was at Broadhaven right up until the time that we launched our business and our fund, which is called Cantilever.
Yeah, it's interesting, Todd. I think you come at it more from I'll call it a top-down or more institutional background, and I've seen it happen both ways in our world, right? As managers that kind of start, I'd consider myself more of a bottom-up guy, entrepreneur, raising money from high net worths over time, doing small deals, working up, and then sometimes meeting in the middle, right? So it's interesting to see people that come from the institutional world that start their own fund and have a lot of perceptions about how it works, right? And then I think you learn what works and what doesn't. So this will be an interesting conversation, I feel.
Yeah, I agree. There's a lot of different ways to come at it, and one of the interesting things about the business that we're building is we see a lot of different approaches. So not only building our own business, but the managers that we're investing in, a lot of different approaches, as you just said.
Yeah, and I think so. So maybe I'm going to take a small pivot, and then we'll kind of come back to some of the lessons learned as you set the fund up. But you're involved in GP stakes, so I know that you're making investments in other managers. So you see a lot of managers and you see a lot of strategies. Share a little bit with folks about what is GP stakes? How do you do it? What do you like about it? What is that? Now, I know it's a newer asset class generally, but kind of fill people in what GP stakes means.
Yeah, so what GP stakes is making minority equity investments in asset management businesses. So the GP of a fund or a series of funds. And it is, Matt, you're right, it's new as an asset class per se, although it's not unusual. The track record goes back a long way. It's not that unusual to make a minority equity investment in another business. But the asset class in total really took off starting 10 years ago. And the insight was that although asset management, and I'm sure there are a number of people on the call here that this observation will resonate with, the insight really was that although asset management is not a balance sheet intensive business, it is a business that can benefit from growth capital. And we can use a fund manager can take our investment, which is permanent passive capital, and use it really to accelerate the growth of their business. And it was that insight that really sort of led to the dramatic increase in the market as a whole. The biggest participant in the space is a firm called Dial, which is part of Blue Owl now. And they're by far the largest, but their flagship fund was a 2014 fund. And that was kind of the grandfather of the industry that we're in.
Yeah. So when you're looking at GP, what kind of GPs are you looking for? Like, what is a characteristic of your ideal customer profile? How big are they? How much capital are they taking from you guys? What percentage are you taking of their company, et cetera?
Yeah. So we are focused on the middle market. There are now a number of firms that are focused on the larger market. That includes Dial. And then kind of the next rung down are names like Bonaccord and InvestCorp and others, all of whom are looking to write very large checks, $100 million and up, as investments into the firm. We are focused on smaller opportunities. So we like to write $20 million investments, maybe 15, maybe 25, into businesses where we think the enterprise value is 100 million or more. Typically, that if it's a private equity firm or certain types of real estate firms or a private credit firm, it's often a firm that is on their third fund. Maybe they're on their fourth fund. They've been successful from both an investment perspective and a capital raising perspective, and are starting to think about the next chapter of what they can achieve as a business. And so our investment is, under the right set of circumstances, can be helpful to those types of firms. These firms are usually profitable, even before you get to sort of earning carry, so profitable on a management fee basis. And that's a typical profile of the type of investment we do. We are reasonably agnostic about asset class, the underlying asset class that the manager is investing in. We like private equity. We like all the different versions of private credit. We like much of the real estate space. And then there are other off-the-run or nichier asset classes that we think are quite interesting as well. And so from a business model perspective, or from a type of manager perspective, we are evaluating and hoping to make investments in a very wide range of different business models.
Yeah. Well, that's fascinating, man. And I could go the whole rest of this time on deep dive on that side of things, but maybe we'll save that for another webinar. What I would like to move toward is a little bit about your experience as a fund manager, because obviously you come at it, you know a lot about managers because you're investing in them. You've advised on it for a long period of time, but you're a first-time fund manager coming out of the institutional world. What has been, tell us just broadly, and then we can get into some specifics, but about the experience of setting up and starting your own fund.
Yep. Look, it's hard. It's been, as I've said already, I came with an advisory background, and everybody said it's really hard to raise capital and start your own fund. And that has certainly been the case for us at Cantilever. I can comment on some of the business models we've seen, but as it relates specifically to our business, we are a first-time fund with no track record, which makes it, which those are two huge strikes against you. Because of that, it took us almost 5 years to find our partner. And what we really did was we believed that we needed to find a strategic partner that could put us in business with a large check, and then use that and actually deploy capital with that, make investments with that capital, such that when we went out to raise capital more broadly, that we would be able to point at specific deals that we had done and build a pipeline. And so we are there now. Our partner is a firm called BTG Pactual, which is a publicly listed company in Brazil. They have been fantastic partners, and they made a commitment to our fund 2 years ago, and we spent 2 years really understanding the flow in the market, and have only just recently launched a capital raise for the balance of the capital. We're trying to raise a $500 million fund. And but look, it took 5 years to find BTG. And a lot of people tell me what we were doing was uninvestable. Some people were more colorful than that. And the fundraising environment, as I'm sure many people on the phone know, the fundraising environment is very challenging right now. If we had gotten to where we are today 3 years ago or 4 years ago, it probably would have been easier. It does feel like it's getting a little bit better, but raising capital for a first-time fund with no track record has certainly been a challenge, and is different, honestly, Matt, than many of the firms we're investing in. I think they come at it from a different direction, a little bit probably more like you, where you start as an investor and build that out on the strength of a real sort of definable track record.
Yeah, so you have I'll call it a seed or a lead investor, right? That came in at is $100 million, right? Is that so? That's a fifth of the fund, and then how are you doing, if you don't mind sharing, since then, and what is your capital raise strategy from there? Are you targeting other institutions or family offices, or what's your expectations and experience there?
Yeah, so we decided early on that we would have very little traction with traditional institutional investors, let alone with the consulting community. And so our marketing efforts have really been focused on high net worth individuals, family offices, RIAs. And the one area where we've gotten traction on the institutional side is with insurance companies, because of the nature of what we're doing. And we've been, although the fundraising environment has been difficult, GP stakes is topical, and a number of investors are curious about it because it really marries, as an investment, it marries the kind of the cash flow characteristics of private credit. So we think we can drive an 8 to 10% net yield, but also the overall return profile that's approaching what you would find in private equity. We think we can get to a 20% IRR in our portfolio. And that profile is the combination of yield and growth is unusual, not unheard of, but unusual. And so we have been pleasantly surprised by the interest levels that we have seen within those groups. The other thing that has been helpful to us, and it's why the insurance companies are, why we're getting traction with insurance companies, is we are creating a portfolio of what we think will be very, very interesting lower middle market asset management firms. And there are many firms out there, whether it's a RIA or a family office or an insurance company, that knows that they need to be bigger in terms of making allocations to alternative managers, but haven't necessarily figured out a way to do that in a deliberate and thoughtful way. And so some of what we are pitching to these larger institutions, these larger family offices, is that we can be a part of that solution. We are, in effect, curating a list of interesting managers that can be available to our investing partners. And so that's resonated with people. But we the consultant community has no interest in talking to us, and most most institutional investors were just too early and no track record.
Yeah, but it's interesting to hear someone coming from, the world of Goldman Sachs and kind of like I described the top-down institutional approach, saying you're too, premature or whatever for institutional capital. And I kind of chuckle because, in my world, people that think they're going to jump in and raise money from large pension funds are just, by and large, just deluding themselves, right? I mean,
yeah, it's really hard, and the large, there are angles you can get lucky, but the allocation and investing decisions at these large firms are pretty formulaic, and they're pretty rigid, and there's just not a lot of upside for them to take a risk on a new manager. If you're sitting at a big public pension and you make an investment in Blackstone, nobody's going to fire you. But if you make an investment in Cantilever and something bad happens, you made a bad decision. And so it's in some awkward ways, it's a little bit like dealing with governments. There's not a lot of incentive to swing for the fences, and there's a lot of risk personally to allocate capital to smaller or less established managers.
Yeah, it's the newer version of the old adage that nobody ever got fired for buying IBM, right?
Exactly. It's exactly that. And that's why it's hard to, some of these large institutional managers have emerging manager platforms and this, that, and the other thing, which are very institutional ways of overcoming biases. But it's still, for a first-time fund, for a small fund, for an off-the-run type asset class, it's really hard to, I think it's hard to get into the larger institutional allocators.
Yeah, and anybody out there that has questions, please type them in the Q&A. We'll go a few more minutes and then we'll open it up to questions. So if you have something you'd like to hear from Todd, please type it in. So Todd, you've mentioned some words that I find that words get used by people in ways that they know what they mean, but others will have a different definition of those words. And I have seen that some people, and I'll call it, more of the bottom up world that I've come from, be successful with insurance companies more so than pension funds, because they tend to have a little more, flexibility, right? And they're not overly flexible, don't get me wrong, but compared to a large pension fund. But how would you suggest to people that they could consider approaching an insurance company, and what does that even look like?
Yeah, I think I agree with that observation. On the other hand, I would say that in the corporate world, insurance companies are notorious for making very, very slow decisions.
Yeah,
and so I think that what we've experienced and are currently experienced is that there's a pretty long selling process. And we've one of the insurance companies, I won't name them, that we've now spent 18 or 20 months, and they're effusively flattering in terms of what we're doing and how much they want to work with us. But it's been 18 months and there's no money, right? And so I think that insurance companies, some of the middle market I think insurance companies are gradually becoming a little bit more aggressive. They're gradually realizing that they can be paid in the form of enhanced return for their ability to make longer term investments. And so I do think that it's the case that insurance companies are increasingly open to investing in earlier stage managers than perhaps they were in the past. But it's a long selling cycle, I would say. You're not gonna, we're 10 or 12 or 15 meetings in with this insurance company I mentioned, and I don't know how much longer it's going to go.
What is your raise period in the fund? And because I presume you didn't really even launch until you had the lead investor at 100 mil. So then, but you've got some finite time frame, right? Yep. To fill up as much of the rest of it as you can. do you expect to be able to get all the way to 500 million? And how?
Yeah, I mean, we're optimistic right now that we're going to get to 500 million. There are scenarios we think where we could do better than that, actually. Although we I think we don't want to do a lot better than that, because that really describes what we think the investment opportunity is. We're going to have a first close on third-party capital, non-BTG capital, probably at the end of March, if I can crack the whip on the attorneys over the next couple of months. And then I think we'll have a final close in early 2026, so 9 to 12 months out from our first close. And then at that point, I think we'll have the capital that we need to pursue the investment opportunity. So we're kind of, and we didn't, we only really launched the capital raising process in the fall. So we've been at it for probably 4 months now. And we did that deliberately because we wanted to show some of our investments, and we've made 2 investments. We're about to make 2 more investments, and so we'll have a portfolio that's 60 or 70 million before we ask third-party investors to come in, so they'll be able to see and touch that. And that was we did that deliberately to just overcome the first-time fund with no track record and hard to find institutional capital. The theory always was, let's show them some deals, and that was part of the discussion with BTG, and they agreed with that approach and came on board on that basis, that we would be investing their capital so that we could show folks what the opportunity is. And that we kind of got to that point in September, and over the next month or so, as I said, we're going to make a couple more investments. So we think that will be a good accelerant to our capital raise.
Yeah. So before we move to Q&A, maybe we'll have 1 or 2 more questions here, but like, as you went through the process to launch, right, you came out of your latest role at Broadhaven, and what process did you go through to decide, okay, you decided you want to start a fund, you hired a lawyer, how did you go through that process, and what lessons might you have learned that you could share with some people during that process?
Yeah, so it's interesting. I would say that there's a range of different approaches, and I have a lot of former colleagues that have taken a different approach to starting their own businesses. And on one end of the extreme, it's a low cost bootstrap type model, and on the other end of the extreme, you raise a big pile of operating capital and build out a team and really expect to raise capital to cover those costs. And we're really on the bootstrap side, and so we have not raised a bunch of operating capital to pursue this opportunity, and so we relied on favors from friends and other things to kind of get off the ground. We did hire a good legal advisor. They agreed not to bill us for 12 or 18 months, and they helped us with some of the initial setup. Setting up the fund documentation you can't do without attorneys, and so ultimately that we had to start paying for that. We've since actually switched legal firms for our primary advisors, and then it's all of the other belt and suspenders. We did our compliance through an outsourcing arrangement. We've outsourced our CFO on a consulting basis effectively, and then we hired a fund administrator,
which wasn't us, by the way.
I know. I hired them before I met you.
Yeah, much to my dismay, but
we'll find it. Don't worry about that. We'll fix that.
Yeah. But the point is, right? An administrator, and not plugging administration. Obviously, in your world, it's table stakes, right? I mean, it's not much of a choice but to hire an administrator, right? Yeah. And the compliance shop and the lawyer and all the others, right?
Yeah, and the accountants. I mean, look, we one of the things we haven't touched on, but part of our model is to actually take our fund public in the United States. And so a lot of the things that we've done have been with that goal in mind. And so we have PwC as our accountant and some high-powered attorneys on both the corporate side and also the deal side, because ultimately 3 years, 4 years from now, we think we'll be a public company, and so we just want to do that way out of the gates.
Yeah, and I'd say that's also I'd say a top-down thing. Most, ground up, aren't really thinking about becoming a public company. Although I would say the lesson in that I would attempt to impart to people is that the more you can build things into your fund management early on that are called best practices or industry standards or more institutional looking stuff, the better off you are in that. And you can do that without necessarily hiring, PwC or there are ways that are cost effective to be able to try to do that and just build it up over time, right? That's beneficial for anybody trying to raise capital.
Yeah, I agree strongly with that statement. I think particularly sort of process and procedures, if you can get that right from the outset and not kind of go back and fix it in 2 years or 3 years or 5 years, that seems like the right approach. And it's just one less thing to worry about. And you don't have, look, there are fantastic law firms that aren't based in New York that are, much more cost effective. And the same thing on the accounting side. There are, very, very credible smaller and regional firms, and most of our managers that we're investing in are using those types of names, so we're very comfortable with those.
Yeah, and we have relationships with many of those kinds of people that you're describing, and it's pretty regular that we make those types of introductions for managers, and they can kind of go from white shoe Big Four all the way down to the corner CPA and everything, and there's a whole range in between. So you just need to, what can you afford and how high up that spectrum do you need to go and so forth.
Yep, I agree.
All right, well, we got a few questions here, so why don't we jump to that? Let me kind of move through. Here's one from George that says, Todd, can you speak to the top 2 or 3 mistakes that new fund managers make in their first fund or two? And maybe some of that can be from your own experience, but I think yours is different than a lot of folks that are on the call, but maybe even with the managers that you see, right? What do you think some of the top couple of things are that managers can do to avoid those mistakes?
Yeah, so I guess I would say a few things. Number one, I mean, the surest way to blow up an asset management business is to make bad investments, and particularly bad initial investments. And so, and we don't even see those firms because they don't ever get onto, they die in the first fund. But make no mistake that everybody lives and dies on investment performance. And if you're well established, you can ride out, a downdraft in your asset class or an issue. But if you're just starting up, a bad investment will kill you. It'll make it impossible to raise capital. And so that maybe that's obvious, but certainly that's what I would say as a first stop. I think the second thing is, I personally am biased this way, but also in the business models that we've seen, I'd encourage people to keep it simple. There tends to be this, I don't know, bias toward or notion that complexity is good. I think when you're starting out, keeping things as simple as you possibly can saves you a ton of time at the outset, but also a ton of time in the future. And so, if you can have one fund as opposed to a bunch of SMAs, for example, that simplicity sets you up, I think, for success in the future. And so that would be kind of the second lesson learned. I'd say we've seen a lot of business. I'm just looking at business model. It took me an hour to understand the org chart, and I'm not sure I understand it. And it's needlessly complicated, and the friction of that can manifest itself in a lot of different ways that aren't obvious. And so I think that would be the second pitfall to avoid, is to overly complicate things.
Yeah, and I would say both operationally and looking, I've been guilty of overcomplicating some of the things we've done over the years, and the complexity of the fund structure, getting too cute with the share classes, the splits, the promotes, the way something works, multiple, side letters. There's all kinds of ways to complicate it that make it hard, that you try to avoid. I would say, to your latter point around SMAs and, let's say, one-off JV deals with, I'd say most of the folks that I know, on average, would end up doing some amount of that, because it's just really hard to raise enough money in the fund at the outset to handle, the deal flow. And you get some, beautiful deal you want to do, and you can't get it done in the fund. Most managers will try to either syndicate that deal or do a JV with somebody or whatever. But ideally, over time, you graduate away from that into doing all of it or as much of it as possible in the fund.
Yeah, I think that's right. There is an evolution there, and look, SMAs are an appropriate part of a lot of business models, and some business models rely almost entirely on SMAs. So that was maybe not the perfect example. Early on in my career, we did a lot of work with TPG, which obviously is a wildly successful private equity firm, but their internal organization and how they handled their economics within the firm were so cumbersome and difficult to unravel that it took them years to even put themselves in a position where they could go public. And they were on one end of an extreme, and that, again, I think there's the value of simplicity is sometimes underappreciated.
I would agree with that. All right, maybe one more question. There's a number of them on here that are questions that I'm certainly happy to answer offline that maybe aren't as applicable with Todd. But here's one that I've heard from a number of people, Todd, in your space, that I was listening to. I don't know, maybe it was you on another podcast, or somebody from a Dial, or one of the the big GP stakes but it says, by the third or fourth fund where Cantilever is doing a GP stakes investment, what value do you bring to the fund besides capital, and why do they need you at that stage if the fund has already, quote unquote, made it?
Yeah. So that's a good question, and it gets to the heart of why there's an investment opportunity here. So number one, we actually think that our capital just by itself is strategic. It enables an acceleration of growth, and it may also, so the uses of our capital are growth capital, so increasing GP commitments, hiring additional teams, and then about a third of it is restructuring the capital stack. You've got a retiring partner, you've got an angel investor who helped stand up the business that would like to get some liquidity, and then about a third of it is taking money off the table. Most of the firms that we talk to have done, by definition, have done well, and that's the implication of the question a little bit. But interestingly, most of these firms, the principals of these firms are wealthy on paper, or potentially wealthy on paper, but not, the cash position is not great, and they're 110% invested in their firm, and in effect, the firm has outgrown the ability of a personal balance sheet to subsidize the growth. Yeah. And so that's why our capital by itself, we think, is strategic. In addition to that, most of the firms that we're talking to are in the middle innings of building a business. Like, they're fully institutionalized, they have funds, they have attorneys, they have accountants, they have they've got a business. But the principals have been maniacally focused on investing and raising capital. And they're kind of now have created some capacity to say, hey, what do I do now with this business? And so our ability to help them answer that question, to advise them on next steps, is unusual in this size. They don't typically have access to advisors that have been advising companies like this for 35 years. And so a number of the firms that we talk to are happy to have us make an investment, to have access to us to help them think about what the right next steps are. And then beyond that, we are ultimately, like many of the other GP stakers, we will build out our ability to be helpful in specific areas of need for these managers. So that it could include capital raising, that can include outsourcing, that can include best practice, that can include advising on generational transfer. And so all of those things will ultimately be a part of our platform. But remember when I said earlier, we're bootstrapping this. We didn't want to build that until we actually had a portfolio of investments, but that's certainly part of the business model.
Yeah. Yeah, well, there's a lot more we could talk about, but we're kind of running at the end of our time slot here, Todd. So appreciate you being on. Got on the screen how people can get a hold of you, but the best way, your email.
Email's great. And I appreciate the opportunity, Matt. Thanks for the invitation. It's been a pleasure to be on, and happy to carry on the conversation if folks want to do that offline.
Yeah, thank you so much for being here. We'll have to have that admin conversation there one of these days. So, all right. Well, thanks everybody for being here. We'll be back again next month with our next one. I think we've got a guest from a family office that is actively allocating to the space, and the topic will be hearing about how family offices think about investing and managers and allocating capital and so forth, and kind of hear from the inside. So please join us for the next one. Todd, thanks for being here. Thanks everybody else for being here. Have a great day.
My pleasure. Have a good one.
Thanks, everyone.